I am delighted to welcome you all to our real estate program, which is a collaboration between the Breslin Center for Real Estate Studies at Hofstra Law School and the Zarb School of Business. And this conference is under the expert direction of professors Ehsan Nikbat and Andrew Spieler at the Zarb School. This conference is truly their labor of love. I am Ashira Ostrow. I'm the executive director of the Breslin Center for Real Estate Studies at Hofstra Law School. I'm also a professor at Hofstra Law School, and I teach a variety of property law and real estate classes. And now I'm really pleased to introduce you to the acting dean and associate professor of finance at the Zarb School, Dr. K.G. Viswanathan. Dr. Viswanathan is an expert in international finance and banking, corporate finance, and investments and security analysis. He is a CFA charter holder and a member of the CFA Institute and the New York Society of Security Analysts. And before coming to Hofstra, Dr. Viswanathan taught investments and corporate finance at the University of Tennessee, and we're certainly very glad to have him here now at Hofstra. So I'm going to turn it over to him.
Thank you, Professor Ostrow, and let me also join Professor Ostrow in welcoming you all to this conference. Before I introduce our keynote speaker, I would like to take a second to thank Professor Nikbat and Professor Spieler for putting together this conference. We have been doing this for the last 15 or so years, and each year we've been bringing in speakers from all over the world, and it's been really interesting and exciting to listen to all of these speeches. So I have the pleasure of introducing our keynote speaker for today, Jeff Katz. And Jeff is no stranger to Hofstra. He's been to Hofstra a couple of times, and he's been a frequent participant at different events here. Jeffrey Katz is the Chief Technology Officer of Global University Programs at IBM, where he's involved with the application, development, and innovation of IBM products, services, technology, and research for electric power companies and related organizations. He is a senior member of the IEEE and a member of the IBM Academy of Technology.
Zhou, and I'm an assistant professor at Hofstra University. We will spend the next 1 hour and 15 minutes for a panel discussion, and I will be the moderator for this panel discussion. So thank you very much for joining us. And we have 4 panelists today, and each panelist will speak for about 15 minutes without interruption, and we will defer all questions to the end after all speakers present. Our first speaker is Mr. Francis Poeta. Mr. Poeta is currently the principal agent technical leader at IBM. He also worked as a cloud evangelist and architect group leader at IBM. Before joining IBM, Mr. Poeta worked at P&M Computers during 1992 to 2015 as a Chief Technology Officer. As Francis elegantly put on his LinkedIn webpage, he is a co-creator, always questioning to expand boundaries to deliver results, a business person with a grounding in risk versus reward, and a leader with a deep conviction that people come first. So please join me today to welcome Mr. Poeta for his presentation. Francis, you have 15 minutes to present. The floor is yours.
Thank you very much. And first, let me say thank you for inviting me back to my alma mater, and hopefully all of you will be alumni of mine shortly. And so go Hofstra. It was a wonderful time, and I'm glad I learned a lot of the stuff that I'm going to talk about that didn't even exist when I was there. So let me start presenting, and we'll move through it. Maybe I'll make up some time from the last one. So at IBM, we have a new mantra that talks about, let's create. So we're going to create something that changes the world, and I'm going to talk about metaverse and NFTs and how you can create yourselves and drive business with emerging technologies. It's not something that's in existence. You create it. You create, and you have this enormous ability to change the world from where you're at today. So let's look at what the history of this metaverse is. So I'm sure most of you think that Meta came about with Facebook, with Oculus, but in reality, back in 2008, IBM created the first true metaverse called Second Life. And we have patents, we have lots of patents back in the early 2010s around what you can do and how you use it. So our scientists, our researchers have always been thinking about where the next state is. Well, that next state has now come to fruition. And now we're looking at where do we go from here? And so I published a couple articles here that are available for you to see and go and read. They're from our scientists. They're published in scientific journals. They're published in on our blogs, and they're with our business thought leadership group about the different ways that you can use these technologies to change the world, right? And we're not talking about technology for technology's sake. It's really important that when we think about technology and we think about how we drive it, we think about where we're going to bring business. And when we bring business, we bring each of us. So where is that beginning with? Well, right now we're taking our blockchain system and we've combined it with partners, in this case, IPE. And what we've built is an ability to use blockchain in a metaverse NFT environment to take a patent and use blockchain smart contracts to be able to understand when patents are used and how they're paid for. So no longer would you need to go to very high priced law firms to get how I could use a particular or pay for using a particular patent. We've made this as part of code sitting inside of a immutable ledger in which the information would not change, and we can know when people are using it. But where else can we use this? So let's talk about headless commerce, right? How do you today buy things, especially after coming out of a pandemic, right? Where do we shop? How does that physical world that we used to go to the mall or we used to go to the store, how does that change? And then how do we interact as human beings, whether that be with AI avatars, whether that be with how we communicate with the person we're buying from? How do we do supply chain? So that's one place that metaverse plays into and NFTs plays into. Another place is in advertising. Now, my main focus day in, day out is around how I help advertisers change the way they do business, how they go to places they haven't gone today, how do they market differently, right? And how do we build technologies that allow them to accomplish that? So whether that is getting more first-person knowledge about everyone, whether that is about personalization and knowing who you are and why you shop and why you're in their environment, to how do I find influencers or people who you listen to and you trust when they advise you, right? This is all part of the metaverse that's coming about, right? Today, we would say that this is mostly done on Snapchat or TikTok, but that won't be the future. Now, a lot of this comes around based on technology. So for those who don't know, then when we all had first mobile phones, there were no apps because the mobile phones couldn't serve up applications. The hardware had to change. The hardware changed. All of a sudden, we had an explosion of applications. The same thing will happen in the metaverse. Right now, we have the Oculus devices, and we have a few other devices but they're not. It's not the most ubiquitous device in which you can experience metaverse, to experience an out of physical existent behavior. When those device technologies catch up, the explosion will be there. So today we're talking about how do we start thinking about what we need to be ready for when the devices are there to go forward. I'm sure many of you have smashed freezers. This is metaverse. This is from my client. My client created Wendy. And if you play Fortnite, you've seen Wendy, and you probably participated in that event of smashing freezers. But wait a second, why were we smashing freezers? Because Wendy's doesn't freeze meat. And so now a whole generation of people and a whole group of participants realized that Wendy's smashes meat. That's the power of thinking about how you create with metaverse technologies and NFTs. But it's not just that. So it's virtual events, it's virtual real estate. It's how do you change the world you live in today by utilizing the technologies that exist today, and as they progress, the technologies that add on to it. So where's that glimmer of gold? Where's the next? If we've done all those and we're walking down that path, how do we find the golden road, right? What is it? So how do we create meta humans? How do we create avatars? Now we're not talking about DC Comics here, right? We're not talking about those kind of meta humans. We're talking about AI, the AI representations of human beings that have or characters that have characteristics that give us value in a virtual world, right? Whether that's me leaving a message as an avatar to my great grandchildren, or to be in a session like this where I'm not a two-dimensional image on a screen, but I'm actually a person in a virtual environment that can interact with you, that can say hello and shake your hand, or can walk up to you and say, you know, I wish you all the luck, and your degree will matter, and you will learn, and you will succeed in life, right? That's a different experience than me sitting here on camera, which is a much more two-dimensional. I'm broadcasting to you. You can only participate by listening. You can't really interact with me. The next thing, and the bigger thing from our standpoint, is how do you take NFTs, non-fungible tokens, and make them into business? How do I conduct business with these non-functional tokens? How do I build the infrastructure, the underlying architecture, the financial institutional devices that need to be in place, so that if it is a fungible token, that if it has value, it has values not just today, but it has values in the future. And how do I have that from a sustainability standpoint, so that there's a record that this virtual entity that I have has value 10 years from now? So what does it look like underneath the art? Now, in all honesty, since my friend said he wasn't a finance major, I actually was trained at Hofstra on the other side of campus in the theater department. So I grew up in Hofstra in the arts. So, but I'm now in technology, because education means learning. And so what does that mean when we talk about building this, right? How do we take domain specific focuses? So how do we do digital token foundations? How do we do marketing infrastructure? How do we take compliance, right? Because now we're talking about value. There are value, you need to have compliance regulations. How do we do custody? You own an NFT, you own an experience. How do I know you own it? And then finally, how do I value that? How do I get a monetary financial value? And how does that financial value grow over time into an investment portfolio, right? Well, first thing I need is I need a platform. I need to figure out what that platform is. I need to understand how I design that platform so that those functionalities can sit on top of it, so that my asset vaults know where they're going to store, so that when I sell and buy, there's a history and a long-term retention of that information. And then underneath it all, I need the actual physical software, right? And the infrastructure, just things don't exist in the air. They exist on some piece of physical device, and those devices need to be upkept, and devices change. So my 8088 that I got in 1984 is not the same thing as my Mac today, right? So how did something that I bought in 1984 matter today in 2022? How do I keep track of it? So one of the ways we have to think about this is, okay, well, I have pillars, right? I have these tokens, I have markets, I have regulations, right? I have assets, and then I have currency. And then I have to understand, well, where do those fit in the when I'm building this? Do I want to focus my time in architecture, in blockchain, and in scalability, and in fractional behavior, or do I want to think about how I would do reserves and how I would do loyalty points or digital identity? Or do I want to look at how would I do brand integrity and logo fraud or GDPR? So these are all avenues in which you can participate, whether you be in IT or finance or in marketing or in business, in a new world that is being created around this virtual representation of physical identity. And it's not just us, it's not just IBM. This is a huge group of young startups, of long-term companies like IBM at 115 years, to companies like Google or Amazon or Microsoft. We're all doing this. We're all creating together, because no one entity will ever do this. It won't be Meta only. It won't be Google only. It won't be Amazon only. It will all be hybrid. It will all be all of us together creating a better world. And that's what we all do as technologists. So we have to figure out how we use our technology. As Jeff said, when we work with AI, we spend a lot of time making sure there's not bias in AI, right? We have to make sure that these systems, these metadata systems, these NFT systems, that they are without bias, that they are without prejudice, that they are without being able to be hijacked, stolen, ransomware. But creativity starts because of you. It's creators like each one of you who can use your imaginations to do the unimaginable, right? That's the core basis that I want to leave with you, is that even in this newest technology, it's all about creating. It's all about thinking about things that don't exist today and making them happen. If you get involved, you're not going, you say, well, I'm not an expert. I just started learning this. I'm in finance. How do I get in from finance? You get involved by thinking about how you create, how you change the world to be the world you want to leave. I want to really thank everybody. It's always a pleasure to come talk to you folks at Hofstra. My heart is always with you. I wish you all the best. And thank you for the time to talk.
Thank you very much, Francis. So again, I noticed some of you raised your hand. Let's delay all the questions to the end, just to make sure that we will have a better control of time. So our next speaker is Dr. Andrew Birkin. Dr. Birkin is a head of research at Bridgeway Capital Management and oversees the development and implementation of Bridgeway's investment strategies. He also produces thought leadership material for clients and prospects. Prior to joining Bridgeway, Dr. Birkin was a co-chief investment officer and the director of research for Verisymmetry Advisors. Dr. Birkin has published numerous research articles in peer-reviewed journals and co-authored 2 books. He is also a reviewer for the Financial Analysis Journal, a prominent journal in finance academia. So please join me to welcome Dr. Birkin for his presentation. Andrew, you have 15 minutes to present as well, so the floor is yours.
Okay, thank you very much. Let me start my timer. So this talk is based on a book that I wrote with Larry Swedroe. The book goes into much greater detail with plenty of citations of peer-reviewed papers to support what I'm going to say. My goal is basically to give you some understanding of what factor investing is and how you can make use of it. It's going to come from my viewpoint as a practitioner who not only uses it, but I have to explain it to clients and others who might not be as much into the weeds as I can get. As mentioned, my role at Bridgeway is head of research, and my duties include developing and enhancing our factor-based strategies, as well as explaining them to clients and prospects through books, journal articles, white papers, and talking. So I'm going to share my opinions about the factors that matter and what we have some conviction about at Bridgeway. But more importantly, I'm going to share how we developed our conviction and walk you through a methodology to help you decide for yourselves which factors that matter. Now, I'm going to start with a word from compliance, and that is that, the old canard, if you will, that past performance is no guarantee of future results. It's a phrase that is typically found in marketing material, and for very good reason. And that is that study after study find that investment performance does not necessarily repeat. And in fact, that predicting future performance by any means can be very, very difficult. So how does this jive with the title of my talk about reducing uncertainty with the factors that matter? Sorry, I'm speaking a little quickly to make it go into 15 minutes, hopefully. So first off, please note that factor-based investing does not guarantee higher returns. But what a factor-based investor should be able to deliver is higher exposure to those factors that matter by selecting assets with appropriate characteristics. And with conviction in those factors, one can hopefully stay the course through tough times and enjoy the long-term good performance that should come. I should note, by the way, my talk will be focused on equities, although factor-based investing has been applied to a number of different asset classes. So terms get tossed around a lot. There's a lot of jargon. Let's start with some basic definitions. What is a factor? Well, a factor is a numerical characteristic or set of characteristics that's common across a broad set of securities. And these characteristics can come from sources such as market data, like price, return, yield. It can come from accounting data, such as earnings, book value, sales, assets, liabilities, and it can come from analysts through their earning estimates or their price forecasts, their ratings of companies. An example would be the value factor, for which the PE ratio, price to earnings, is one characteristic used to measure value. Then what is factor-based investing? Well, factor-based investing uses factors to select securities and form portfolios. Everybody looks at asset characteristics, but what differentiates factor-based investing from, say, the typical stock picker is the systematic application of these metrics across that wide swath of securities. Now, hundreds of factors have been identified. In fact, many call it a zoo of factors. So which factors do we choose from among them? How do we make that decision? How do we gain confidence, especially that these factors are likely to persist into the future? Well, one thing we want from the factors we use is that they help to explain returns and that they provide a premium, a benefit in terms of those returns. But additionally, a factor should be persistent. It should hold across long periods of time and different economic regimes. A factor should be pervasive, holding across countries, regions, sectors, and even asset classes. A factor should be robust, holding for various definitions. A factor should be investable. It should hold up not just on paper, but also after considering actual implementation issues. And finally, a factor should be intuitive, with logical risk-based or behavioral-based explanations for the premium and why it should continue to exist. And we think that these criteria provide a practical guide for deciding which factors matter. Well, the good news is that using these criteria, you can gain certainty on which factors to use. And these factors given here are those that we find matter the most for equity investing. We've got market beta, size, value, momentum, and quality or profitability. You may already be familiar with many of these, such as size or value. One thing to note is that a factor is typically expressed as a difference or a long-short portfolio. So market beta, for example, is the excess return of the stock market over the risk-free rate. Size is the excess return of small stocks over large stocks. Value is the excess return of cheaper stocks relative to more expensive ones, and so on. Now, to see how our factor criteria work, we'll focus on several of them: value, momentum, and quality. And the importance of the next few slides is not so much the details of how these criteria are applied to these specific factors, but rather to illustrate how these criteria can be applied to any factor, so that hopefully you can go and do it on your own in the safety and comfort of your own home. Let's start with persistence, that a factor works across long periods of time and different economic regimes. Furthermore, we want this outperformance not to be concentrated in a few narrow periods, but to hold broadly over time. Now, we can see in this chart, it shows, for example, that values have positive excess returns in 63% of the years, and it's been even higher over longer periods. In fact, since the 1920s, momentum has always outperformed over 20-year horizons. But it's important to note that while these factors typically do work, they don't always work. Over 5 and 10-year time spans, there have been times when each of these factors has had negative returns. Value, for example, just recently went through quite a dry spell, especially when measured using book to market. While not typical, it's also not unexpected. And note as well that while momentum has had, so far at least, no negative 20-year stretches, there's no guarantee that in the future, all 20-year periods will always be positive. And that's part of the reason why our 5 criteria are so important: to keep the faith during those periods of underperformance and avoid selling out at exactly the wrong time. Also note, by the way, that diversification across factors can reduce the chances of underperformance. It's a point we make in the book, but won't have much time for today. But certainly value, momentum, and quality have presented very good odds and thus satisfy our criteria of persistence. Now, our next criteria is pervasive. And by pervasive, we mean that a factor holds across countries, regions, sectors, and even asset classes. And the importance is that we'll have greater faith in a factor if we see it working in a variety of situations. On the left, we look at how these factors show up across European developed markets. And on the right, we've got some additional data to support it. So for example, value's been found in broad international markets as well as the US, and in emerging markets as well. Momentum's been found in 40 other countries. It's been positive in different markets and asset classes as well. It's been statistically significant in all of them but Japan. And profitability has been found to exist in Europe with quite a nice premium, and emerging markets, it's been even stronger. By the way, what about Japan, where momentum has not been statistically significant? Well, it's interesting to note that while momentum has not been statistically significant, it has worked there overall, just not strong enough to gain that statistical significance. But what has worked very well in Japan is value, buying cheaper stocks. And value and momentum tend to work at differing times, providing a nice counterbalance to each other. Combining factors can indeed be very powerful. But certainly all 3 factors meet our pervasive criteria. On to being robust. And robustness means that a factor works for a variety of conceptually similar definitions. And the importance of being robust is that if a factor only works for a very narrow definition, we may suspect data mining and excessive fine-tuning. What do we mean by data mining? Well, with access to more data, armed with more powerful and faster computers, and a suite of modeling tools, researchers can try huge amounts of combinations to look for patterns. And chances are they may find some that worked, at least in the past. But if something is so fine-tuned to fit past data, it's far less likely to play out well going forward. So we gain greater faith when a factor works for a broader set of definitions. Now, for value, the most common academic definition is book to market, but we find value works quite nicely for things like cash flow to price, earnings to price, sales to price, and others. For momentum, the most common definition is returns of the past 12 months, excluding the most recent month, but returns over other time periods work quite nicely, as does momentum in other measures besides returns like earnings or profit margins. Quality, a common academic definition, is gross profitability, but other definitions such as return on equity, return on invested capital, operating or cash flow based profitability all work nicely, as do other measures as well. So we see that value, momentum, and quality, excuse me, definitely fulfill the criteria of being robust. Now, on to investable. A factor can work pretty well on paper, but we want to make sure that we can use it in practice. And that's what we mean by investable. There's pretty widespread agreement about the use of value as well as quality, going back to the days of Benjamin Graham. In the interest of time, I'll just talk about momentum here. In the graphic that you see, Lisa is about to push Ralph down the hill. And as Ralph rolls down, he's going to demonstrate a couple of things for us. He's definitely going to build momentum rolling down that hill, and he's going to have high turnover, which has been one of the criticisms of momentum. Momentum does indeed have high turnover and thus potentially high trading costs, which has led some to question its usefulness in actual implementation. But we find momentum to be actually quite useful in practice. One can use momentum to inform trading without increased turnover. For example, avoid buying assets with negative momentum or hold higher momentum assets for longer. And live data lend further support. There's actual analysis of actual trading costs, shows they can be low enough to allow large-scale application. And there are actual funds out there using momentum as well, alone and with other factors. Our last criteria is intuitive. As noted, with more and more computational power, people can try different combinations of variables and see what worked, at least in the past. So it's important to have a good intuitive explanation for why a factor works in order to expect it to continue into the future. A common way to look at this is to say, well, is it behavioral or is it risk-based? Consider for a moment the ski jump image. I like skiing. This is a bit too extreme for me. So what would make somebody want to do it? Is it risk or behavior? And I'd say the answer to that question is yes, it's both. There's definitely a behavioral aspect, as you have to be willing to hurl yourself high into the air. And that behavior makes some people happy or thrilled. There's most definitely a risk component as well. But with the risk of the jump comes the expected reward when you land it. The feeling of soaring, the sense of accomplishment, the awe of others, and a better score in competition. So let's sum it up with some key takeaways. There's been a lot of interest in factor-based investing. Quite simply, it means using characteristics to choose securities and form portfolios. Our criteria of being persistent, pervasive, robust, investable, and intuitive narrows these factors to the handful that matter. And one can form portfolios on the characteristics of these factors, providing certainty of your exposure to them. They may not always outperform, but the criteria used here should give investors the confidence they need to hang on through those tough times and hopefully reap the long-term rewards. Thank you.
Thank you very much, Andrew. So our next speaker is Mr. James Burns. Mr. Burns is the president and founder of Aventine Properties. Aventine is a licensed tax grievance consultant serving the the New York counties, including Nassau, Suffolk, Westchester, and others, that utilized a state-of-the-art statistical system to analyze the real estate markets as opposed to traditional approaches. At Aventine, Mr. Burns provides both residential and commercial tax grievance advices for his clients. James, you have 15 minutes to present. The floor is yours.
Thank you very much. And, 2022 is turning out to be a very, very special year. I learned much about Hofstra Pride and the Lyon family. My daughter is matriculating to the class of 2026. And also, I'm very, very happy to be invited back as a speaker. I was a speaker a few times in 2014 and 2017. And in that time, I had mentioned the possibility of stagflation, and I could not have been more wrong about that. So I'm very glad to be invited back. I'm not sure whether it's due to the current state of the economy or if that had anything to do with it. But I'm going to be speaking on the local Long Island real estate market. We are actually in 13 different counties in the downstate area and going up north of New York City as well. And I'm going to give a little bit of a survey of the local market. Then I'm going to speak to some general macroeconomic trends and how we believe they're impacting the real estate market currently. We'll talk a little bit about yields and interest rates and inflation. And I'll also give a little bit of an example of how people can make money currently in real estate. I think there's a bit of an opportunity in inflation. And lastly, I'll give an example and talk about property taxes, which is our core business. Property taxes are a major holding cost component in residential real estate, especially in the downstate area on Long Island and Nassau and Suffolk and in the counties that we're in. I'll also go through a basic example of how property taxes can impact valuation. Let's get to the next slide. So first, a little bit of a survey on the 2021 real estate market. Many of you might have been reading articles and seen various pieces of information about the hot real estate market that we're currently in. Well, if you look at Long Island versus the nation, there are some similar trends. Median home sale prices have increased nationally. Median home sale prices for 2021 are 346,900, up 16.9% year over year. That is the highest on record, the highest year over year return in real estate since they started recording, since 1999. Nassau and Suffolk and Queens, however, had a lesser increase, although the value's higher. In 2021, the median price is 595,000. That's up 8.2% year over year. So as you read about the local market, you may think, well, this is a great hot market. But if you look at it vis-a-vis the national market, it really seems to have underperformed a little bit. Nationally, sales are up 8.5% year over year. On Long Island, the actual sales are down 16.5%. But this is probably a result of the shrinking inventory. The number of unsold homes is very, very small currently. Nationally, there's only about a 1.8 month supply of homes. That's down 16.5% year over year. And in Long Island, there is only a 2.2 month supply of homes currently on the market. So did Long Island and New York underperform? I think the answer is yes. And the question is why? The graph on the screen shows state migration patterns from most inbound to most outbound. And I'd like to focus on the red states. The red states would be the states with the most outbound traffic. And in New York is ranked 50 out of 50 states, which means it had the most outbound traffic of any state in the United States in 2021. I thought that was an anomaly, by the way, but I looked back and further years, and it seems since 1992, New York has remained in the bottom 10 consistently. So it seems that there is an outflow of state residents from New York to other states. I think this is part of the
James,
yes.
sorry to interrupt. Do you mind? We only see the cover, the front cover of the document. Do you mind to show us the picture?
Oh, did it? Let's see. Why did this not?
It on slideshow, James.
You need to advance your slide.
Up, okay. Sorry about that. Do we have it?
Yeah.
Cool.
Now we
Okay,
have
Thank
the
you.
map.
So the map that we're showing shows in red the states that had the most outbound traffic. Okay, and what I can say generally about this map and New York, generally the states with the greatest outbound traffic are the higher property tax states with larger urban populations. These are the areas that saw the greatest net outflow, and New York has consistently been in the bottom of the in terms of state population changes. So like all real estate markets, local real estate market is subject to broader economic conditions. And I wanted to briefly summarize the current market conditions and what I think is going on. Inflation, of course, was well known. It basically is just the increase in prices of goods and services over time. Whenever you fill up at the gas tank now, you're experiencing that. Recession is a period of decline in general economic activity, typically defined when an economy experiences a decrease in its GDP for 2 consecutive quarters. Other indicators which are usually linked with this include rising unemployment, falling retail sales, slowed manufacturing growth, and a decline in real personal income. These two states usually don't happen at the same time. When they do, the worst of all worlds sort of occurs. That's a stagflationary environment where there's both inflation and recession. And this can lead to a declining standard of living. So stagflation is specifically defined as an economic condition caused by slow economic growth, high unemployment, which we don't have right now, and rising prices, often triggered by shocks, like shocks in oil prices or a supply line shock from COVID, for example. Stagflation last occurred in the 1970s as a result of monetary and fiscal policies of an oil embargo that occurred at that time. But recently, concern about stagflation has emerged as economic growth has been cooling and inflation has remained high and seems to be accelerating as of recently. But let's talk a little bit about the current environment. So right now, mortgage debt is the highest ever on record for 1 to 4 family homes. The outstanding mortgage debt is about $12.5 trillion as of the end of last year. Okay, mortgage rates are extremely low, at least when viewed on a long-term basis. And most mortgage products are based on the 10-year U.S. Treasury, which was at 2.42%. It's higher now, and we'll talk about that as well. As of 3/16/22, 30-year mortgage rates around that time were 4.71%, and inflation at that time in February of 2022 was both month over month at 0.8% per month, which is annualized at 10.03%. You may have seen in the news, or if you haven't, I'm sure you will, that today the CPI Consumer Price Index was released, and it showed an 8.5% year-over-year increase, which is the largest increase. The consumer price increase was 8.5% year-over-year. That was yesterday. That was the largest increase since 1981. Okay. Today, the PPI was released, Producer Price Index, and it showed an 11.2% year-over-year increase, which was the largest increase ever recorded. These numbers only go back to 2010, but monthly that increase was 1.4% the producer price index. If you annualize that number, that is compounded 12 times, it's an 18.15% increase annual rate. So inflation appears to be heating up. The other point that I would make now is we've seen yield curve inversion, which is where shorter term rates are higher than longer term rates. Okay. And so the date that I put this together on 3/16/22, US 2-year rate was 2.48%. The 10-year rate was 2.42. This typically is indicative of a recession when there's yield curve inversion. In fact, the US Treasury yield curve inversion has predicted accurately every recession since 1955 and gave only actually one false signal. So this is something that should be watched closely. I wanted to talk briefly about the US 10-year Treasury because this is the benchmark that's used for mortgages. And typically all mortgage products are priced with a spread over this Treasury. The graph on the screen is a one-year chart of the yield on the US 10-year Treasury bond. So when you look at this graph, you can see how sharply the yields have increased from March to present. Currently, rates are 2.776%, at least when I printed the screen, and that's a significant increase. So when you have higher highs and higher lows here that are occurring, and a rapid increase, the chart investors would call this a breakout. Okay, when you have higher highs and higher lows, and basically the yields are up 121% or 150 basis points in say 21. So it looks like Treasury yields and mortgage rates, which are keyed upon this yield, are very high in a one-year basis, and indeed that's the case. But if we look back over a 5-year period, the graph looks a little bit different. It looks like a much more sort of normal level in the range. You can see that back in 2019, we had 3% 10-year Treasury rates. And it really is sort of, even though there has been a sharp appreciation recently, it sort of is in the normal range that we have observed in the last 5 years. And it looks very different over 5 years. Well, if you look back over the entire history of the 10-year Treasury, it looks much different. What it looks like is the US 10-year Treasury is actually at a very, very low rate relative to its history. Now, what I find interesting in the very long term is the peak that we saw back here in the 80s. And the high point here was July of 81. And at that point, the US 10-year Treasury was yielding 15.82%. And when I looked at that number, what struck me is that the annualized increase in the CPI was about 18%, which is a rate that we've seen for mortgages back in 1982. And there's no question that inflation is going to be a metric that's considered by bond investors and mortgage lenders. Lenders can't afford to lend money at a rate which is less than the rate of inflation. So I guess what I take away from this graph is really the differential. Even though the rates seem high now, they were about over 13% higher in history. And there may be some parallels that you can draw with the period, the stagflationary period of the 80s and what we're currently experiencing. So in terms of making money on real estate, there may be an opportunity here because you can effectively borrow at negative rates. There are negative real rates. if the cost of a mortgage is 4.71% and inflation is running at 10.03%, there's a negative 5.3% rate of borrowing. It's a negative real rate of borrowing, at least in the short term. And if you were to buy a home, a typical home, for example, at 1.25 million, I know that seems like a high price. I chose it to do the math easily. And you put 20% down, which is typical. You'd put down $250,000 and you'd borrow $1 million in a mortgage. Well, if you obtained an interest-only product, which is available, you'd pay $47,100 in interest over that year. But your real estate, if it increased at the rate of inflation, would increase 10.03% or $125,375. And that would result in a net gain on your personal balance sheet, for example, of $78,275. So, and that percent gain would be even larger because the increase of 78,000 net that you have in as a percentage of your down payment of $250,000 is 31.31%. Okay, so you effectively are able to borrow at 5.3% negative rate on $1 million is what it turns out to be. So, and I think this is one of the factors that's driving real estate currently, because real estate is one of the easiest assets to borrow on, and it is increasing rapidly. Let me just watch the time here. I want to go through a quick example on tax grievance math, because as a downstate real estate investor, taxes are the single largest negative holding cost associated with a piece of property. Generally, taxes are equal to the assessment times the tax rate. Okay, so assuming an assessment is at 10,000 and the tax rate is 200%, a tax bill would be then $20,000 per year in that year. There's a measurement that's used to determine whether a property is assessed called an equalized market value. And what's done is the assessment is divided by a level of assessment called a residential assessment ratio to give you the effective market value of the property for tax purposes. So continuing with our example of the assessment's 10,000 and the level of assessment or residential assessment ratio is 2%, then this property with a $20,000 tax bill is being valued as if it's worth $500,000. And it may or may not be worth that much. So fortunately, there's a mechanism to reduce assessments that's available to New York State property owners. If the property is not worth $500,000, let's assume, for example, I just bought this property at $400,000, then its fair market value would be $400,000. And the question to ask is, what should it be assessed at if it's valued at $400,000? Well, the fair assessment would be the value of the property, the real value of the property, times the appropriate level of assessment. In this case, $400,000 times 2%, which is the level of assessment, or 8,000 should be the assessment. So you can see the fair assessment's 8,000 and the assessment that the property currently has is 10,000. If we get the assessment reduced from 10,000 to 8,000, a 20% reduction, then taxes are reduced by 20%. So the property had a $20,000 tax bill, which was the assessment of 10,000 times 200%. But now, after we get a reduction to the assessment of 8,000, its tax bill goes down to $16,000, a savings of $4,000 per year every year. Now, briefly, the assessment is permanently reduced. So this $4,000 savings is an annual recurring savings. And I'm sure many of you from your finance courses have encountered the formula for perpetuity. But if we take the cash flows of the $4,000 per year in this property and discount it by an appropriate rate, we can determine what the present value of that is. In this case, I'm assuming a 5% discount rate and a $4,000 savings. And the formula for perpetuity is simply the cash flow, the cash divided by the rate, which is $4,000 divided by 5%, or $80,000. So what's happened here? What's happened here is by obtaining this reduction, By obtaining this reduction in the assessment, we have added in value $80,000 to the value of this house. We have reduced the negative cash flow by $4,000 a year, and this adds $80,000 to the value of the home. It's like effectively the same as giving someone $4,000 per year, which they would give you $80,000 for today, assuming a 5% rate. So just to quickly sum up, because I know I'm running out of time, some quick final thoughts. We're really in an unprecedented time, or at least one that's not familiar to many people. I think there's some similarities to the 80s in terms of the stagflationary environment which exists. And there are significant opportunities which I think are occurring because of dislocations. And you need to stay informed. Read the financial news, watch what's happening, evaluate expert analysis, assess and evaluate things yourself. Look for the signs of what's going on. I think it's a high inflationary environment, possible stagflation, and consider where you might want to invest. I think that real estate, as most commodities, can be a hedge for this, a hedge to inflation. And mortgage loan rates lower than the rate of inflation can make real borrowing cost negatives. That can present an opportunity. Mortgages are the largest and easiest loan for consumers. And residential real estate, because of the tax situation, is usually a negative cash flow asset. So if you do decide that you wanted to invest in real estate, at least downstate, you have to really look at the property taxes, because it could have a profound impact on the value of the house. It's the single largest carrying cost in a residential piece of real estate. So thank you very much for your time. I think I'm just about out of time. Thank you very much.
Thank you, James. So our next speaker is Dr. Amy Ashmawi. Dr. Ashmawi is a two-time Fulbright alternate and a regional relocation specialist in the U.S. Department of Housing and Urban Development in New York City. She oversaw major government asset management contracts as a Level 3 GTR, has spoken at congressionally mandated events and conferences, and assisted in the framing, policy writing of multiple pilot programs. She is also an adjunct professor at Fordham University. Her research focuses on infrastructure economics and urban design in the Arab states. So please join me to welcome Dr. Ashmawi for her presentation. Amy, you have 15 minutes to present. The floor is yours.
Thank you so much. So I'm just making sure that I'm setting this up properly quickly. So if you just give me 1 second. Is everyone able to see my screen?
Yes.
Okay, fantastic. So good afternoon, everybody. My name is Amy Ashmawi. I'm the Regional Relocation Specialist for Region 2 with the U.S. Department of Housing and Urban Development. Let me just go ahead and make sure this is set up properly. Am I doing? Oh, it's not allowing me. I'm so sorry. There we go. All right. So today's discussion is going to revolve around the Uniform Relocation Act from 1970, which was enacted by the Department of Transportation. I think in the recent, past 2 years, there's been updates for the Uniform Relocation Act, which basically mitigates anything related to relocation of tenants, businesses, or homeowners when federal funds are being delved into a project. But what we find more often these days is that regulation implementation has become more difficult due to the increase of digitization of paperwork and forms, and implementing regulatory processes through electronic methods. So there's some recent reflections that we've noted in our division regarding how to implement the Uniform Relocation Act, and we'll go through that today. So what I'd like to do is go over the Uniform Relocation Act in totality, how we are as a department digitizing the regulatory framework, and then to give 3 examples from 3 very, very different cities of how our division and the U.S. Department of Housing and Urban Development has been able to implement the Uniform Relocation Act to ensure that tenant rights and homeowner rights, business rights are, are abided by basically regulatorily. So the overview of the Uniform Relocation Act includes a very important relationship between the Fifth Amendment, where all individuals, whether, they're business or residential owned, if they're privy to eminent domain or permanent or temporary relocation, have specific benefits and rights if the property that they're living in will be used for public use. This all comes from the Fifth Amendment and was enacted in 1970 by the Housing and Community Act of 1974. It's really important to point out historically the impact of the Bronx for the Uniform Relocation Act. In particular, in the 1970s, there was, for those of you that are from New York City proper, incidents where portions of the projects in the Bronx burned down, and it had been evident that people would be out of shelter and that infrastructure was not safe anymore. So the Uniform Relocation Act essentially and portions of the Housing Community Act came into play to ensure that people would not be put out of shelter, essentially, if anything was going to be built or designed with federal funding. The regulations for the Uniform Relocation Act, and this would be, kind of important to know if you're a student of policy or economics, if you're a practitioner of housing or the real estate industry, is put out by actually the Department of Transportation. So there's several acronyms that you see on the screen in front of you. CFR is the Code of Federal Regulations. Those are the overarching regulations for any kind of a federal agency. 49 CFR 24 is Department of Transportation's Federal Highway Administration regulations. And we follow that even though we are not DOT, we are HUD. And HUD is the U.S. Department of Housing and Urban Development. So there's various acronyms that apply, and I'm bringing that up because I know that there's a large constituency today of students in the audience. But it's important to know that just because a regulation is put out by another federal agency doesn't mean it won't apply to another program or project that a different agency is working with. So the Uniform Relocation Act itself covers most HUD grant programs, and there's a couple exceptions to those programs. So more acronyms: CDBG, which is Community Development Block Grant funding. That kind of funding comes from capital funds doled out by the Congress. And so your federal dollars are going towards CDBG, home, choice neighborhoods, and multifamily housing programs. CDBG and home are the crux of our work, essentially. So what does that mean? It means that when grants are handed out to agencies, so local, municipal, and state agencies by the federal government, whether they are CDBG, which can go towards any kind of funding that helps to strengthen a community, or home funding, which is any kind of funding that goes towards strengthening homes alone, choice neighborhoods, which takes blighted neighborhoods out of their blight and into their functional, stable neighborhoods programs, and multifamily housing programs. Multifamily housing programs would include FHA financing. So FHA is one stream of financing. It's responsible for 52% of the market share. So when you get a mortgage on a property, there's various ways to finance it. There's conventional, and then there's FHA. So one of the streams that URA doesn't cover, more importantly, is a program called Section 18. So when you hear that a developer is demolishing and rebuilding a property with federal funds, it's not necessary that the URA would be privy to it. So does that mean that people get put out of home? No, it doesn't. It means that there's a completely different set of regulations that are followed. The Uniform Relocation Act applies to most programs, but not all programs. Single family home purchases and foreclosures also do not apply. So just to reiterate quickly, the URA basically ensures that private property shall not be taken for public use without just compensation. For those of you that have studied eminent domain, I'm sure you recall the Kelo versus New London case, which basically decided, it was a Supreme Court case in early 2000s, that basically decided that the public good is more essentially important than private ownership. And if a neighborhood's economic viability will be put to better use than a single property, irrespective of the historic and sociocultural nature of that property, then the economic viability of a neighborhood will take over. So will you be compensated for that property? You will. Will you be relocated under the URA? You will. So the URA is basically the implementation procedure for the Fifth Amendment. One thing that's not mentioned in the regs is temporary relocation. So temporary relocation is when individuals have to be out of home for less than 12 months, but they're going to be brought back to that property. And that's usually in cases of rehabilitation and not demolition. That's important because if you look at New York City proper, for example, it's very hard to temporarily relocate people. You add the COVID element to that, and how to inform people that they need to be relocated is a completely different atmosphere. So the URA is important for temporary and permanent relocation, which requires some type of regulatory response so that individuals are guaranteed their rights. So the more people that we inform that they have rights regarding relocation, whether it's via paper or via digital documentation, the less people are displaced, and that could decrease the number of homelessness across the nation. So if you think about it in terms of COVID, how do you inform people that they have those rights? In the past 2 years, we have had to find creative ways in order to do that. So we'll get to that in a second. So to reiterate, the purpose of the URA is to minimize displacement, excuse me, to ensure a one-for-one replacement of properties. So if a property is demolished, one has to be put back on the market. We're talking about low-income housing here. And it provides relocation assistance through our regulations on 49 CFR 24. The funding stream that would apply to URA includes homeowners, tenants, and business owners. So the impact for URA, it impacts any real estate or non-real estate project, investment, rehab, where there's some type of federal funding that goes into it. So the developer, the real estate agency, the municipal agency, the state agency, applies for the funding. And if we deem that people have to be relocated, we'll look at that first, and then we'll decide whether the funding is warranted. Agencies or developers working with HUD, such as tenants, homeowners, or business owners will be displaced. If they will be displaced, it'll trigger the URA regulations. So, you have to imagine there's hundreds of projects across the United States happening at once, or thousands actually, in various types of programming. And you can imagine the impact of COVID during, that period of time, whether it was on construction or whether there was labor constraints or whatnot, or, economic implications that would have impacted projects. So, and it also impacts some FHA financing projects through although single family is not really privy to that. So when we're looking at multifamily housing, we have various senior housing projects that are financed, and you get into discussions of how easements are impacted and how individuals can be, brought back into their properties, into the properties they were in if they were once displaced. And, it became extremely cumbersome, extremely difficult to work through some of these cases during COVID. So how are they impacted in general? So HUD awards funding to agencies and entities. The agency in turn awards funding to recipients. And once the funding is released, HUD holds the agency responsible to make sure that no tenant is displaced. Therefore, funding is the trigger for whether a program or project is impacted by the URA. And I think you all received a copy of this. We don't have to, go through all of the mitigating guidance, but I think the takeaway from this is that, HUD regulations cover everything that's funded, whether it has to do with eminent domain. And when we talk about eminent domain, we're talking about involuntary relocation. Anything that falls under the Fifth Amendment, but it also covers all disaster recovery and presidentially declared areas. So disaster areas. So, it's a very important regulation that's often dismissed, that's often set aside. And the more people know that their tenants have rights, if there's federal funding going into low-income housing, the more people are covered. That's important because in New York City, for example, there's over 500,000 people in public housing and almost 227,000 that are on the wait list. So you have to, take a look at that and see that all of those tenants have rights that are not often discussed, aside from the vouchers or the placements that they're receiving and in now. So how do we digitize the regulatory framework? The most important way that we do that is to make sure that the regulations are available to every single individual from a, so sorry, my computer is not working, there we go. The most important way to do that is to make sure that tenants have access via, computers and whatnot, and access via, online information materials. So for researchers and practitioners and students today, I'm sure you know of the thomas.gov website, the loc.gov website, and the HUD URA websites, but you also have the various readers for the law interpretations that exist. I know Cornell is a very big one. So that would be, another way that we're able to get the information on the URA out to the public. The implications of making sure the information is available for COVID purposes, especially for what we have now, is that the allocation of benefits for those who are impacted by URA is now more streamlined. So you have more of a utility, a community utility from technology that results in the efficient interpretation of URA regulations. Projects also can be completed quickly, and individuals can get back into their properties in a more efficient manner. So timelines are decreased due to technological methods that the government is attempting to implement right now in order to make sure that our regs are properly abided by. So our staff has created multiple modules, and we can have a discussion about that later on as to where to access them. I have the links available for public agencies, outside stakeholders, and internal HUD staff. We've acclimated to disaster recovery and presidentially declared disasters conjunctively with agents' needs, meaning if you recall when Sandy hit New York City and the New Jersey coastline, we had to move quickly. And so I'd say that was probably the impetus. That particular storm in 2012 was the impetus for us to start digitizing a lot of information for the public. We've also provided regulatory implications that are allowable via digitization to streamline regulatory implications. So some samples of URA digitization, and this would also not just apply to URA, I'd say it applies to other programs as well at HUD, so environmental concerns, economic departments, research engines. So we've really attempted to try to push the digitization at HUD, and the URA is probably the largest, indicator of that. So one of the regulations we have in 49 CFR 24 requires that tenants and homeowners and business owners receive specific notices at specific times. The distribution methods for that have, been streamlined digitally as well, where USPS has been very helpful in ensuring that certified mail can be accessed via email. Advisory services, we have Zoom and we have Teams and we have various online systems in order to ensure advisory services. GIS and mapping importance. I won't look at a case of how a tenant should be, relocated or if they're going to be displaced unless I see the developer's architectural designs and their GIS mapping. So I can see the economic impact and the structural impact of what happens with the buildings. And then lastly, cross-referencing research internally to assess programs and projects impacted by the URA. So what happens in the environmental division could impact a structure in our division that in turn impacts what happens to the tenant and how long they're out of home. There's also a state municipal impact of mortgage and lease moratoriums on projects. So there's certain states such as such as Nevada that decreased the, well, they didn't decrease, they started moratoriums late during COVID. Also temporary versus permanent relocation timelines. Projects were shortened and projects were lengthened depending on where they were in the country because of a labor shortage in construction and staffing and low retention rates in agencies. The method of delivery for homeowners, tenants, and business owners was completely different. So a business relocation is very difficult to complete, especially during COVID when half of the businesses in major urban areas were shutting down and Small Business Administration was handing small grants out. So we also have issues with waivers. After 12 months, if you're out of home, you're permanently displaced. We do have waivers, but they're cumbersome and they take a long time. So to get approved by headquarters. So there's a lot of elements related to COVID that forced us to have to look at digitization. 3 case studies. I feel like I'm a few minutes over right now, but a few case studies would include New York City. So when we're talking about a practical application of the regulations relative to how we've attempted to digitize regulatory interpretation and implementation, New York City is this huge, gigantic metropolitan city that was the COVID epicenter. Homelessness increased due to various factors, but mostly due to labor market issues and illness and a lack of hospital beds in the very beginning of the pandemic.
So Amy, sorry to interrupt. You have about 2 minutes
that's fine.
left. Yeah,
that's fine. So we'll go through this a little bit faster. So anyway, the point is you're looking at a New York City example where COVID would have increased the number of displacements of individuals in affordable housing. And the results was a dependency on the digital notices that we handed out because there was nowhere to send them. The second example is Minneapolis during COVID. It's very cold, but Minneapolis has one of the best homelessness models in the country and the best shelter models in the country. So we knew that timelines for projects were going to increase due to the low weather climate and the impact of COVID essentially on the labor market. So having said that, Teams and Zoom really helped Minneapolis a great deal, helped the agencies a great deal, especially because they had high agency turnover. So another example of digitization of notices and implementation of our regulations. And lastly, Las Vegas. Las Vegas is what we call a non-judicial state. And so any legal actions that are being had in the courts related to housing or real estate should be more streamlined, but due to COVID, they were not, even though the city was more open versus other areas. And the moratoriums for leases and mortgages came actually later than most other states in Las Vegas. So we had an increase of displaced individuals. So delivery notices, though, were much easier because of the climate and the weather that existed, and just an attempt to push affordable housing projects to be completed in a shorter period of time because of the climate. So and we were able to assist on those projects because of that. So that's pretty much what I have for today as examples. We can chat a little bit more about more regulatory implementation methods after this presentation.
thank you, Amy. So even though we're slightly over time, so we would still prefer to give some time to our audience for a Q&A session. So we would like to have 15 minutes Q&A session. So just to recap, so that the audience would know who to ask. So our keynote speaker Jeff talked about the emerging technology trends, and Francis talked about the impact that the metaverse could bring to our society, and Andrew talked about the factor investments in finance, and James talked about the inflation and its impact on the real estate investment, and Amy introduces the Uniform Reallocation Act. So if you have any questions, please feel free to unmute yourself and ask. So do we have any questions from the audience? Yes, go ahead.
Hi, I have one question to ask from Puerto. And I think there is an echo. Let me see if I can turn it off. 1 second. All right. That was very interesting topics, connecting metaverse, NFT, and blockchain. I like when he brought these 3 connections of this technology. I want to know, is that necessarily we need to have connection of this for metaverse, or there are other alternatives? Or if you can just give brief elaboration on it with one
Yes.
Can you hear?
Yes, I'm responding. Can you hear me?
Yes.
So, okay.
Okay. So yes, there is ability technologies than blockchain. Blockchain solves a very a fundamental problem of long-term immutability. But you could also solve immutability with immutable databases. You could solve it other ways. What the blockchain also brings is contracts, right? So it brings smart contracts. Smart contracts are much tougher in any other platform, right? Now, understand that in blockchain, as we had on our last discussion, that I was there are two different types of blockchain. There is the public blockchain, the one that takes massive amounts of processing power and electricity and all kind of other things like Ethereum, that may not be a good solution for this. There's another type of blockchain, which is a permission-based blockchain, which doesn't necessitate that kind of compute power for every single authenticated transaction. So when we talk about blockchain in IBM, we can do upwards to 30,000 transactions a minute. Generally, Ethereum, the public blockchains are looking at between 7 and 10 transactions a minute. So depending on which way you choose, right, it can impact your ability to do what you need to do for a large scale worldwide rollout of a solution.
Thank you.
If that helps.
And then with the NFT, the same thing you're saying, you
Yes.
know.
Well, NFT more so than metaverse. So if we're just talking about simple metaverse, the artistic part of metaverse, then you don't need any blockchain for that, except for long-term immutable storage, right? Which you can solve in other ways. NFTs, where you're talking about needing to control money and transactions and digital currency type transactions, then that's one where you would be better off with a blockchain, because you would be able to track long-term value easier than maybe in an immutable database. And also the cryptology of making sure that you're the real owner. And did you, if you created, so let me give you an example. I as Procter & Gamble, let's say, create an NFT, and because you're a great customer of mine, you get an NFT, but you really like the New York Yankees. And so you take my NFT and you give it a Yankees flavor. Well, maybe that's a really good thing for your followers, and it gets them to use Procter & Gamble. So should I not get paid for the work that I did as Procter & Gamble, but maybe you get a piece of it for the work that you did in creating what you did? So we both now get pieces of the value of what was each of us created, even though yours was a derivative of what I created, right? So there's a lot of things that we haven't really seen the answers to. That's why I said it's all about creating. What can we do that nobody else has done before?
Thank you. That was an interesting connection. Thanks.
No problem.
Thank you, Francis and Abraham. So by the way, if you prefer, you can also send me the question via the chat. Okay, I can moderate for you. So do you have any other questions? So here's one question I received. I think this is asking for Jeff. So in your opinion, as a fintech advances, how will trade automation, trade performance analytics, and AI impact trading professionals?
Okay, can you hear me? I had to relocate my computer.
Yeah, we can hear you, Jeff.
Okay. Oh, and I saw a pop-up about the video. I'm not in a room where I'm going to reactivate the video. Can you repeat the question?
Yes, the question is, in your opinion, as the fintech advances, how will trade automation, trade performance analytics, and AI impact trading professionals?
If the question is about automated computer instruction, or the computer as a teacher, which is what it sounds like to me, that has been tried a long time. And, the best we have so far is, automated testing and reinforcement. Okay, so, and there are obviously a lot of successful online courses. IBM has some, many universities take a subset of their courses and use them for MOOCs, massive online courses. So, while it's effective, there's a certain amount of instructor interaction that's needed. And I would say having an AI device or an AI software look at your test scores and automatically suggest, review sections 6 and 10 or something like that, or maybe even offer up an alternative explanation for something in a learning process. That's tractable, but it doesn't seem to match the online interaction. The courses that I host at IBM designed for university professors, we do 30 hours of online WebEx over 2 weeks, 3 hours a day for 10 days, plus the self-study aspect. And that seems to be a workable compromise. But direct AI education, I don't know that I've seen a lot of examples. Maybe the person asking the question could clarify in case I'm answering the question he did not ask. Or was that the appropriate response?
Yeah, thank you. Thank you, Jeff. I think this question, first of all, it's kind of asking the application of AI. I think you addressed, the technology side, but maybe Andrew, do you want to also say something about the application side?
Yeah,
for AI in trading, in factor investments.
Yeah, I'll try to make it a little general and then not ramble on for too long. But AI, blockchain, all these things have become very important in finance. Generally speaking, it's led to potentially new asset classes such as NFTs, such as cryptocurrencies. So that's one area that certainly some people are very excited about, and I am I'm less informed. Things like the blockchain and fintech, more generally, has applications in terms of keeping better track of records, leading potentially, for example, to faster trade settlement. Is one important application. And then finally, with respect to something a little more, closer to, to my heart too, is looking at things like AI techniques, machine learning techniques for trying to model financial processes. That's a very, very hot topic right now. There's a lot of people claiming a lot of great results. I guess I'd say this is where, again, the criteria that I laid out becomes important, and especially the one about having a good explanation. Being wary of something where you run a gazillion different techniques against these huge data sets and you manage to find a few which randomly just hit. So it's important to not just find something which is random pattern matching in the past, but something that's going to work going forwards. And for that, you want to have some idea, ideally, about what's actually going on. Why is it working?
Thank you, Andrew. So I have another question for Jeff, and then we'll go to the question that just popped up in the chat. So the second question that audience asked to Jeff is, although there are no plans to regulate the metaverse as of now, should it be regulated? By whom should have the authority to regulate? And I kind of, maybe this is also related to what Francis said. But Jeff, do you mind to provide some of the thoughts first?
Okay, I'm not using my headset now, so can you repeat that again? I'm going to make my volume louder.
Yeah, so although there are no plans to regulate the metaverse as of now, should it be regulated? By whom should have the authority to regulate?
Okay, I mean, I did touch on regulation, but Francis is the one that talked about the metaverse. So you should probably let him ask that question, right?
Okay. So Francis, do you want to respond to this question as well?
Sure, I will. So two pieces of this. There's a metaverse piece that is a creative piece, right? And there should be no regulations on creation, right? There's a metaverse piece, there's an NFT piece that is a value, right? So how does that value get translated? What is the financial value of that instrument? And how does that instrument change over time? That, you know, that's a question that I would leave to regulators, banking regulators, right? I mean, that's not a question for technology. That's a question for society, and that's a question for whether or not, you know, who owns currency and how currency should be controlled and regulated. And there are good reasons for why, in my opinion, there are good reasons for why currencies need to be regulated. Right. So I mean, I don't want to I would never want to see regulations put on the creative part of what you create with it and what you use it, but the values and how we determine what a currency is, I think needs to be regulated.
Thank you, Francis. So the last question that we have, well, we have two questions, but I'm afraid that we only have time for the first one. Although the first one is quite long, I'm just, moderator for the first part. So during the pandemic, this is a question for Amy, by the way. During the pandemic, have any displacement agencies contacted you for guidance on restrictions imposing hardships on them regarding their ability to locate comparable units? And did it exacerbate existing disparities among vulnerable populations?
I can see the rest of the question. I think it'd be easier if I just answer through it. So yes, there have, multiple agencies have contacted me. So my jurisdiction is the state of New York, the state of New Jersey. And, probably one of the largest questions I've gotten is, can we displace past a 30-mile radius? Or I'm sorry, can we find a home for someone who's displaced, a comparable unit past a 30-mile radius? So of course, everybody's leaving New York City. And if you're crossing into New Jersey, it's past the 30-mile radius, but it's another jurisdiction, it's another state. So therefore, if you're low-income housing voucher, it's very difficult to get that transferred to New Jersey, especially if you've had it for more than a certain number of years. So so that's one of the restrictions I suppose we've had. The second restriction we've actually had is not being able to get the waivers necessarily approved within a reasonable amount of time to extend them past the 12-month regulation. So it did exasperate, I'd say, the disparities, because when you put someone out of home, it automatically decreases the middle class from an economic perspective. I don't know if there's someone that isn't on mute, but sorry about that. So it exasperates it that when you have an increase of individuals leaving homes, you're automatically going to decrease, the middle class, and you'll end up with a larger, lower class constituency, I guess, in the city as well. So that's really more of an economic question, I would say. And all of these communities, all these populations are vulnerable, absolutely. It's not just privy to New York City and urban areas, it's also privy to anything in upstate New York, and especially in southern New Jersey. And then the rising housing costs and inflation. So, I think the gentleman before me had touched upon the inflation, question. And I would say, I completely agree with that discussion as well, that, housing cost increases, are an indication. The methodology of how the statistics look when home ownership happens, when it occurs, and when market values go up in price in specific zip codes and neighborhoods. I think that it is a complete indication of inflation. I think it's the largest product in the market that indicates inflation, actually. And I think that displacement agencies' ability to relocate displaced people or opt for home ownership, push them into the home if that was not the appropriate, avenue for them to go once they left New York City, whether they went to Long Island or upstate New York or New Jersey or wherever. So I think that options for displacement agencies as a result of that to combat inflation is to increase affordable housing. So whether they're using low-income housing tax credits from the state, or they're applying for more home and CDBG funding from HUD or other federal agencies, I think the ultimate solution is to have more developers that are willing to develop affordable housing programs and affordable housing stock in order to ensure that everybody has shelter.
So thank you, Amy. And thank you very much for all our speakers for your excellent discussion and presentation. Next, I will hand over to Dr. Ehsan Nikbak, who is a CV Star Distinguished Professor in Finance and International Financial Services, for the concluding remarks. Ehsan.
Thank you, Michael. Thank you, Michael. Along with my co-director, Professor Spieler, I would like to thank all attendees, students, faculty, people from outside. The speakers were wonderful. Jeff, Francis, Andrew B., James, Amy. And I want to thank, Professor Ashira, the director of the center, for her support. Our Dean, KG, always supported us, encouraged us, and I thank KG in particular, Laura Fetter. Without her skill of coordination, project management, we would not be here. Thank you, Laura, and I give it back to you, Laura.
Thank you, Ehsan. And I just want to reiterate what Ehsan just shared, that we are really just wonderful to have everybody with us today. I hope you enjoyed the presentation. It was our pleasure to coordinate with the Zarb School of Business on this conference that we've been doing for many, many years. And we hope that you have a wonderful rest of the day and that we see you all again next year. Thank you so much, everyone.